Welcome to the third day of our Model Portfolio Review Week. We appreciate you joining today on this nice afternoon. So John and I are tuning in from the Chicagoland area, and Cindy is tuning in from Indiana. You can always use the question section of your GoToWebinar control panel. Should be on the right-hand side of your screen to let us know where you're tuning in from. We always like to hear. The last couple of webinars, I think we've seen everywhere from Hawaii to Maryland, just really across the nation. So it's fun to see where everybody is kind of tuning in from and listening to the webinar today. And then I always like to ask our audience if we have any growth investing portfolio holders here. If so, we'd love to hear how many stocks in the portfolio that you're currently holding. So you can feel free to share via the chat. And it's the chat, but it's also called the question section of your GoToWebinar control panel. So you can get used to that while everybody's kind of settling in your answers, but we are really happy to have you here. We appreciate your time, and we have so much to cover. So we'll begin in just a few more seconds.
Yeah, we welcome our local chapter leaders that have joined us, I see on the chat area.
That's great. All right, since we do have a lot to cover, we're going to jump right in. And yeah, so here we go. So hello and welcome to this afternoon's webinar, AAII's Growth Investing 2025 Portfolio Review, led by John Bajkowski and Cynthia McLaughlin. Thank you so much for joining us. We're happy to have you all here. My name is Jenna Brashear, and I'll be your host for today. We really appreciate you joining us for the third day of our Model Portfolio Review Week, where we'll be taking a look at the AAII Growth Investing Model Portfolio. Each day this week, we're highlighting a different AAII model portfolio. So tomorrow at 1 p.m. Central, we'll be joined again by Cynthia, and she'll walk through the VMQ Stocks model portfolio. If you want to register, there's still time, so please visit aaii.com/webinars, and it is free to register. But before we begin, there are a few things to go over. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. If you want to view or read our full disclaimer, please visit aaii.com/privacy/disclaimer. And then please keep an eye on your chat throughout the webinar, as I'll be sharing helpful resources, some links that pertain to the content of today's event, anything else I think it could be helpful. And if you have any questions for our speaker during the presentation, please submit them using the question section of your GoToWebinar control panel. Once our presentation concludes, I'll select a few for Cynthia to answer, or John will. And then if your question isn't selected during the broadcast, feel free to email us at members@aaii.com. Our presenter slide deck is available under the handout section of your GoToWebinar control panel and will be emailed to all attendees, probably early next week. If you please visit the GoToWebinar website for support at gotowebinar.com if you experience any issues with the audio or the video during the webinar. This presentation is being recorded, and a replay of the webinar will be available on our YouTube channel, also on aaii.com/webinars. That's kind of the hub. And in this presentation, Cynthia will cover a few things, such as learning how to identify companies built for long-term growth versus those riding short-lived trends. You'll be able to gain expert insights into the standout performers of 2025 and some pivotal shifts in tech stocks going into 2026. And you'll discover the rules-based strategy that has guided AAII Growth Investing's model portfolio performance. And then we have a special offer for today's attendees. So if you get a $50 discount on any new one-year subscription to an AAII premium product of your choosing, including AAII Platinum, by visiting aaii.com/webinar-week and entering the promo code WebinarWeek50 at checkout. And we know that's a lot of information to digest. I threw a lot at you, so please don't worry. I will add it to the chat momentarily so you can easily access and have everything at your fingertips. And with that, I'd like to hand over the presentation to John and Cynthia.
Hi, everyone. Happy New Year. First of all, I hope you're all happy and healthy as we enter this new year. I'm Cynthia McLaughlin. Thank you so much for joining today. I am the new growth editor for the AAII Growth Investment Portfolio. I'm really, really excited about this. I've been currently working on VMQ, which I'm really interested in as well. I won't forget about VMQ as I move over to growth, but just wanted to introduce myself. Jenna mentioned that I live in Indiana. I live in the Indianapolis area with my husband and my Great Pyrenees dog, and I belong to a running club. So just a few fun facts or tidbits about me. And I want to really give a warm welcome to our current growth subscribers and to those who have joined today just to learn and listen and are considering subscribing to the growth investing platform. So thank you all for joining, and let's get started. So the agenda for this session is to walk through the growth strategy and also take a look back at 2025. John is going to navigate us through that. And then we're going to talk about what is in store for 2026, what are some of the market risks or risks for the portfolio, what are some of the opportunities, and what we are thinking about doing with the portfolio as we move forward into this new year. So just thinking about why growth investing. So growth investing has kind of a reputation of being, you know, like it's a really sleek, hot, new, fun. It's kind of that fancy sports car if you want to visualize the way a lot of people think about it. We know that value investing outperforms growth over time, but why does growth investing work? So what you want to do with growth investing is to find a consistent approach that really resonates with you and applies a discipline that you can stick with. So AAII's growth investing, we're seeking to overcome a lot of the challenges, or if you want to think about them as limitations that a lot of traditional growth approaches have. So instead of chasing the highest growth rates, our growth approach at AAII identifies companies with that consistent, sustainable growth. So it really is also for the long term, just like value investing. Value investing, we know, is something that you're going to start with it and stick with it perhaps for many years. There may be many years of underperformance before you see the reward of outperformance. So what we're looking at with AAII's growth investing is a track record of profitability, strong cash flow, and the fundamental factors that signal high quality growth potential in the future as you hold these stocks and move forward. So in our growth investing strategy, we have a 20 stock model portfolio. That's the same as those subscribers who are invested in VMQ will understand in terms of portfolio size. It follows a quantitative rules-based approach. So we're going to introduce stocks as they qualify and meet the rules, and then it also takes care of the when to sell. So I know John has talked a lot about this, and Charles talked about it yesterday also. You want to make sure that you understand your sell strategy as an investor. It's really exciting to go and buy a stock, but knowing when to sell it so you're not holding on to it too long, or also conversely, missing out on returns because you sold it too early. So that is kind of the real high level. And what we're doing with the growth investing, we have two, I would call them elemental criteria. We have the growth grade, and then we have something that we call a G score. So with the growth grade, we're prioritizing companies with the strong sustainable growth rather than just chasing on the highest growth rate. So those of us who lived through the tech bubble and also the tech wreck in the late 90s and early 2000s will know that a lot of those stocks, they really ran up and they were great for a while, but they didn't have that sustainable growth. So we're looking for those companies, positive cash flows, sustainable sales, and I'll get to the earnings part in just a little bit. And this Mohan Ram G-score grade is an 8-factor model, and it's evaluating growth companies by analyzing their financial statements. So we're assessing growth, like okay, you have your companies picked out, then, how do you evaluate them? So we're looking at, again, the profitability, stability, and the accounting practices. Okay. So the selection criteria, just kind of going into when we're thinking about grades and the G-score, what are we looking for? Well, optimally, we're looking for those that have a growth grade of A and a G-score of 7 or 8. And we also incorporate a quality factor. Quality is one of my favorite things. I'm absolutely fascinated about it. I love to write about it in VMQ. But the quality grade needed to reflect strong financial health for the growth investing portfolio is A or B. So the positive cash flow needs to be over the last 12 months, and it's essential for that positive year-to-year sales growth. So the eligible stocks, just thinking about criteria that makes them resilient. Obviously, they're listed on the major exchanges, and we have a minimum 3-month average daily trading volume of 1 million and at least 200,000 shares traded. And then the market cap is 400 million. So the growth portfolio is market cap agnostic, meaning we are selecting stocks based on these factors and not considering market cap. So we're going to get a range of stocks across all market caps that qualify and can be included from time to time. And these next slides kind of go back into the roots of the growth investing product and some of the back testing results. So if you want to think about the companies that have, we're chasing those high returns and we're chasing that high sales growth, the line in red and the line in green, that's correct, right, John? Those are the
Yes.
ones that are not going to perform well, and we're looking for that sustainable type of growth rate. So chasing the higher returns, those higher absolute returns, that's usually a serious mistake.
Yeah, what we found when in this back testing, we try to develop this growth grade for A+ investor, and the challenge we were coming across is that screening or segmenting companies, from highest to lowest, using either expected earnings growth or historical growth, earnings, sales, whatever. The highest performing growth companies didn't always turn out to be the best performing companies as far as stock performance going forward. So we found it actually was better to kind of almost segment it, kind of almost as a reversion to the mean, whatever you want to call it. We found it better to basically, as a predictor of future value, having acceptable levels of growth and other factors such as cash flow and sales over just raw high levels of growth.
That's great, thank you. Okay. And then we also consider annual cash flow from operations, year-over-year sales growth, and the clear outperformance of companies with this consistent year-over-year sales growth over the long term. So one thing to keep in mind, you're thinking, okay, if they have high sales growth, are they sensitive during economic downturns or other events that could, cause an impact, and how do they recover? So their ability to recover positions them as a good choice for the longer term investors. And then if you combine the elements of the long-term and year-over-year sales growth and the annual ability to generate cash flow, this is how we got the growth grade. So the back testing and simulations executed showed that companies that had growth grades of A or B were significantly outperforming those with lower growth grades. Okay, right on. Okay. So the three factors that focus on these areas that have this higher G score and the companies with better performance. We look at, does the company generate strong and consistent profits? Does it stable operationally, having reliable performance over time? And then I'll mention the accounting conservatism. Again, do they use responsible accounting practices that avoid risky or aggressive financial reporting? So we're identifying those companies with the strong fundamentals, and we're trying to provide a tool for looking at growth stocks and making longer term investment decisions. Okay, so looking at the current portfolio, this is the listing of those 20 stocks in the current portfolio, and they are ranked by G score and then growth score. So you're going to see that some of these companies are, very familiar. Eli Lilly constantly advertising on television, Amazon.com, something integrated into our daily lives. Same with Google and Alphabet. Domino's Pizza, I just heard a little tidbit about them on the Today Show this morning when they were talking about pizza wars, but some of these are maybe a little less familiar. DocuSign, which is a technology for processing secure documents, and then we also have like Garmin, that's a fairly well-known name, and Generac is a company, obviously, generators. That is something that may be important if you encounter a weather problem, but a lot of these companies are well known, some of them are not. So we've started to talk about earnings. So how do the earnings work with the G-score? So earnings stability is the most important thing about the G-score. So growing earnings, obviously it requires that top line growth, but it's important to think about that, being profitable, that isn't enough. Companies can be profitable and still have problems. Then looking for those companies that generate enough cash. And another thing that we're trying to avoid, we're about to go into an earnings season, and we'll be reporting on earnings for companies, how they did per what analysts projected. And David Draymond did some research that pinpointed that only 1 in 4 analysts can actively or accurately predict the future earnings fundamentals within 5 percentage points. So it's very challenging to accurately predict earnings. And the way the G-score evaluates earnings gets around this and helps solve for that problem. So beyond earnings, we're looking to incorporate measures that just really look at the financial stability of a company. So one thing that is important, I mentioned that as an investor, it's exciting to buy a new stock, but knowing when to sell it can be difficult and run into maybe some even psychological attachments to a particular stock. So the growth investing takes care of that by we have the rules that we have where if a grade falls to a D or F, which equates to a growth score of 40 or lower, we're going to initiate a sell and remove it from the portfolio. If the G score falls below 5, so if it's 4 or lower, and if the quality grade falls to F. So I believe all of our portfolios incorporate selling when the quality grade falls off. But we're also looking at year-over-year sales growth. If that is negative for 4 consecutive quarters, the 5-year annualized sales growth, if that falls into that bottom quintile of a stock universe, say like 20%, then we will sell. And we talked about the cash flow from operations and how that's important with the growth investing. And if that is negative for over 12 months, over 12 trailing months, or the last 4 quarters, then we'll sell. And we also have a 3-year rule. So if after adding the stock to the portfolio after 3 years and it has underperformed the iShares Core S&P 500 ETF IVV, that is the benchmark for growth, then we will consider selling it. So it has, and if it's underperformed by more than 50 percentage points, and this gets a little tricky from the high closing pricing being added, then we'll sell it. So we're avoiding emotional decisions. We are hopefully locking in gains, cutting losses, and maintaining a good portfolio balance. So these are clear rules to think about, and we've incorporated them. Okay. So next, we're going to talk about the 2025 performance. John, are you ready to kick that off?
I'll give it a shot.
Yeah.
When we before we formulated the actual growth investing portfolio, we went through a series of testing the strategy, and we tried to get a sense, because one of the challenges with growth is momentum is often a factor. So we sort of settled on, or not settled is the wrong word, but chose certain rules that were more probably longer term lasting. The growth score, for example, doesn't fluctuate that much. It's geared more on company fundamental performance of its factors. The G score too helps predict the future value as well. So for the most part, we didn't see a lot of turnover when we were doing this paper portfolio leading up to our actual portfolio. So we were, at the time, we were seeing maybe 2 transactions per year in our hypothetical testing. So now we've been live for 3 years. We're getting a better sense of the kind of turnover to expect. In 2025, there were in effect 5 securities that were in effect sold from the portfolio, and then 5 replacements. The one was an acquisition. Electronic Arts was they were being taken private, in effect, very large private equity buyout of the company, financed by some cases some Saudi money, I think, in that area. And then the three were really based upon underperformance of the market, and those are some of the rules that Cindy was just talking about. And now one of the things we wanted to institute in the portfolio when we got started was having a sense of, well, we want these stocks to kind of build up in terms of quality and have the market recognize the growth potential of these stocks. But after 3 years, if they're still underperforming the market by a large margin, then perhaps time to find new candidates to replace them. And so now, with the portfolio being out 3 years, we're starting to see some of these stocks that have been held for a while, such as Colgate-Palmolive, that was in effect sold because after a 3-year basis, it was underperforming the market, looking for candidates to replace it. So we've had, in effect, relatively low portfolio turnover, 20% last year, and which, that probably conceptually translate to maybe a 4 or 5 year holding period on average for these holdings. But we'll see how that goes out over time. I think the next slide kind of gives us, and we have some slides in here that we might not touch upon in great depth. We wanted to include them just to give a sense for perhaps some background information on what's going on. So this is the performance of the actual holdings of our portfolio over the last year. Some of these were added to the portfolio over time, 5 of them. 5 of them were sold. So if you see a year-end value of 0, that means that particular security was sold at the point of the year-end. These stocks are ranked by their performance over the course of the year. Overall, the portfolio actually had a kind of underperforming cycle for last year. We only had a total return of 5.5% of our actual portfolio. We had some big winners. Alphabet kind of tops the list here with its performance. It certainly benefited from the AI trend, but also benefited from some favorable reaction to antitrust action that was going against it by the government. ASML, a chip company, and they're benefiting from all of these microprocessors that need to be built, and they have to use their technology to help construct these processors. And Eli Lilly, we talked about common names, but obviously the whole weight loss drug phenomenon that's going through the marketplace has been really impactful for them and helping them grow over the course of the year. Some of our weakest performing stocks were also affected by artificial intelligence, interestingly enough. In this case, it's companies that had more software as a service models, such as HubSpot, which is geared towards marketing, email communications. You had DocuSign, which is used very often in the got popular in the back to work from home moment, where people had to share electronically. Well, these are in some cases are companies that are being in Adobe are actually being displaced. Some of their business models are being displaced by the use of AI. Larger AI companies are taking over some of their market share. So AI could be a positive thing and a negative thing as far as that's concerned. But this gives you a sense for overall how, even though our portfolio performance was 5.5, which is kind of matching more the mid-cap, small-cap performance last year, there's quite this big dispersion in the rates of return. And but I think we still have some interesting opportunities here. And when we were talking about building a portfolio, potentially, and Cynthia will be talking about this more later, one of the things you might want to take a look at when you look at our website is see if a stock still qualifies, if it matches all the initial qualification rules as a starting point for stocks to consider. But Cynthia will go into greater depth as far as doing an in-depth look at a company and its performance. Looking at the next slide and kind of reflecting upon perhaps actually let's go forward 2 slides. I would probably talk about these when we're talking about the particular securities. Let's go to the next one. If we could, Cindy. No matter what, I mean, and the big dispersion between the S&P 500 and mid caps and small caps. I mean, the market itself is still very highly concentrated. We have a small number of companies making up a big impact. 47% of the performance of the market capitalization of the S&P 500 is made up by just a few small number of 10 stocks that are in the index. And the green line here represents on the my left, hopefully your left as well, in that chart that shows the performance of the S&P 500 over time. the impact of the top 10 stocks in the index has really, really boosted its return over a period of this last few years, in this case, going back quite a few years, 20 plus years. Without the impact of the top 10 companies, the S&P 500 performance would be more that blue line on the very bottom of that, of that index, as opposed to having that top 10 stocks impact the performance. So concentration is always a factor, and whenever you build a portfolio, try to capture the effect of this thing as you actually invest equal dollar amounts. So we don't necessarily mirror the market capitalization. And when a stock becomes too big in our portfolio, and the diversification risk becomes too high, typically 2.5 times the average position size, we then will pair some of those, take some of those winnings aside and invest them in the rest of the portfolio. So if you could jump to the next slide. This is just further confirmation of the impact of the Magnificent Seven. So let's go ahead, and we've talked about that enough. But when Cindy was talking about, with the next slide here, when Cindy was referring to the impact of profit margins, one more slide, if you could, Cindy, thank you. The impact of profit margins and revenue growth on what really pushes earnings. When we started 2005, the PE ratio is roughly where we had ended the year. So the earnings growth, for the most part, for the S&P 500 stocks, supported. We know what market valuations are high, but the earnings growth helped to support that high level of earnings. And the AI companies are helping to boost the profitability of the S&P 500 index, helping support that high S&P 500 index level. So this is an interesting chart. I thought it was interesting in the sense that it helps explain, when you have profit margins expanding, when you have revenue growth expanding, how that could help boost earnings for companies and help support a higher index level. By the same token, when you have a recession and all of a sudden, earnings, the margins, collapse and earnings become negative, all of a sudden the PE ratio could also move in that regard. Often you have a relatively low PE ratio just before earnings recession, because markets are anticipating that decline in earnings as far as that's concerned. So I thought it was an interesting slide to help understand how impact of profit margins, revenue growth, and how a high valuation, which is a PE, can be supported over time, even though it's potentially extended a little bit as far as that is concerned. Going back, I guess, next few slides are going to be kind of, I'm going to talk about that. If you want to jump to slide 21, one more, Cindy.
Yeah.
Really to be different than the market, to beat the market, you have to be different than the market. And I know you'll probably see this kind of heat map presentation of different sectors and different parts of the market over time. But last year, again, was a year where large cap growth dominated other segments, and we now have, in effect, 3 solid years where large cap growth was the dominant story. And also, over those same 3 years, the communication services and information technology sectors were the dominant sectors as far as really helping push up the performance of that marketplace. So if you are invested in real estate, and as opposed to communication services and the right communication services stocks, you're going to see a big disparity in your performance. So and when it comes to growth investing, we don't make any specific sector or industry attempts to try to pick out sectors or pick out companies within specific areas. It happens to be what the model shows as far as what sectors have the right kind of growth, have the right kind of activities they're doing to help support that growth, the DRE score. But this will impact how your performance does. So with that in mind, the next slide gives us a breakdown of what the current composition of the market of our growth investing portfolio is and where its concentrations are. And as far as the portfolio, and this is based upon our weightings of those stocks within our model portfolio. So your weightings might not match these weightings, and it's not based upon the market cap of these companies themselves. It's simply based upon how our position holdings are and how those impact our performance as you might see it. And for us, we've got 5 stocks in the consumer discretionary sector, another 5 in the information technology. Those are the 2 big areas that are within our portfolio. And the next few columns display the percentage based on market cap of how those sectors compare against the S&P 500, S&P mid-cap 400, and the small cap. So you can see how certain sectors, such as information technology, are much stronger at 31.2% of the 500 weight versus, say, the mid-cap, where they only make up 13.9%. And the industrials, which are very dominant in the mid-cap and small cap arena, are almost, 7.5, almost insignificant at all as far as the impact on the performance of the 500. So as you compare your performance of your portfolio against other indices, understand that the sector weights will vary. So you may see different performance based upon whether or not you're small cap, mid cap, or large cap, and where the opportunities lie. The next few areas or columns just kind of help highlight how certain industries, it's fascinating. Healthcare did bounce back finally last year. We saw a nice uptick in the performance of the healthcare sector, but perennially it's been very low profit. A lot of companies in healthcare are very unprofitable, and it's probably helped depress the return of those particular companies. So some standout companies like Eli Lilly, very profitable, great returns. A lot of companies are struggling to actually make money in that area. So this just gives a little bit of feedback on how you might have a industry that is performing well, has high valuations, and what are the factors supporting those high valuations. Whereas real estate has a relatively high PE ratio, but relatively low profit margins as far as that's concerned. And healthcare, same thing, relatively high PE ratio of the companies that are in that sector, but not necessarily the profits to support all of those companies in there. And again, that helps give you a sense for how we concentrate the portfolio, how it is concentrated by accident, and also how the overall market is composed. The next slide takes a look at, kind of builds upon the earlier slide that Cindy showed had the current market and its composition. This one gives us the performance of all stocks that were held in the portfolio all of last year and how they performed. And just so you have a sense for what our current weights are, we have an end value percentage, which just lets you know what impact those stocks had in our portfolio at the end of the year. And this happens to be sorted by sector and industry. So again, it helps you understand some of our concentrations. And if you see an end value of, in this case, sold, that means we sold it for, in this case, Electronic Arts, because it was a buyout was announced. And while the price was a little bit below the buyout price, it actually reflected the time value of money of reaching to that final ultimate buyout price, which is why we normally, in that context, once we have a board approves of the buyout and the price largely reflects it, as far as any kind of time arbitrage that's built into that difference, we normally go ahead and move on to other securities. Stocks that have an asterisk in front of them are those that actually were added to the portfolio to replace the stocks that were sold. So again, this gives you another view of our portfolio performance and the sector concentrations, in this case, sector industry concentrations that exist within our portfolio. And like Alphabet, so it's right now it's roughly 2% of our portfolio size. So that is one. Once it gets to 2.5 times our portfolio size, we'll pare it back and look to either add that money into stocks that are being added to the portfolio or those that are underrepresented as far as allocation is concerned. Generac Holdings, that was a stock that was hit. Talk about 2025, I think was the first year since 2015 where there were no hurricanes that made landfall in the U.S. So Generac makes all-house electron generators that are automatic in their nature. They run off typically natural gas. It was down 12.1% for the year. Fortunately, I'm glad as a country we didn't have any hurricanes make landfall. I'd rather have a year where that happens. I know insurance companies also benefited from having a relatively quiet year as far as hurricanes, fires, or perhaps something else. But sometimes individual company performance can drive performance beyond overall sector things as well. And with that, I'm going to let Cindy talk a little bit about how to get more information on these stocks on our website.
Okay. So this is the growth investing homepage that you're seeing. And here you will find tabs for the latest commentary with insights, the portfolio, current portfolio holdings. You can look at the ideas list by clicking on ideas, and then we have how to and tools. And you are able to access the growth analyzer at any time. It's always in the right-hand corner of your screen, so you can run pretty much any stock through there if you want to see how it would do in the growth investing rules scenario. So that is the home page, and just wanted to make sure that you know that the performance is on the home page also. So we have the growth of 100K chart. And for those of you who are current subscribers, this may be a little repetitive, so apologies in advance. And the current portfolio holdings list, these are the stocks that are in the current portfolio, and you can look at all the different criteria for, when we added it with the alert, the return. John just talked about returns, and if it currently qualifies, those with a green circle and a check mark currently qualify, whereas the red and the X do not. And we have the growth composite score and grade and a quality composite score and grade, and then what is it straight belongs to, and any notes about it. So if it doesn't qualify, a note will appear indicating which rule or criteria it is not meeting. And then finally, we have news. We have a wonderful intern who works on providing our news each week. So please feel free to take a look at the news and enjoy it as well.
And one additional thing to note, and all of these tables that as a subscriber you can see online, you can also download them as an Excel file. So if you like to collect Excel files, all of these tables can be downloaded into Excel for you to do some further analysis with or work with.
And that's a really great point, John. And the way you would access that, it is not reflected in this screen capture, but if you are on the current portfolios holding page, for example, you would scroll to the bottom of the page, and then there is a little button where you can click to export everything to Excel. So with the holdings, you can also look at the performance, the growth analysis, and any characteristics that you're interested in. And moving on to the ideas list, beyond the current 20 holdings, we have an ideas list, and these are a list of stocks that at any given day meet the requirement for being selected into the portfolio. So think of it as kind of a feeder list, if you will, but just because they are on the ideas list, it doesn't mean that they will be selected for the portfolio. And when we make adjustments to the portfolio and eliminate or remove a particular stock, this is where we go to do our analysis and find something suitable, making that decision. Okay. So a little more about the growth investing ideas. Currently, we had yesterday 43 stocks on the list, and I just picked out some statistics about the median market cap, 8 billion, and the average was 53.5 billion. Walmart was the largest by market cap, 900 billion, and Shutterstock was the smallest with a market cap of 669 million. Back to the point that the growth investing portfolio is market cap agnostic. So furthermore, looking at a breakdown, we had 9 that were in technology. The most, which is 10, were in consumer discretionary, and then some in consumer service, communication services, a few in healthcare, a good amount in consumer staples, and there were no stocks from energy or real estate that met the growth investing criteria for the ideal list. So looking at the analyzer, if you go to the growth analyzer, a while back with the VMQ commentary, I ran the VMQ stocks through the growth analyzer, and I noticed that BJ's was a company that qualified. So I wanted to just run it through again and see what it looked like and use it as an example. And when you run this a particular stock through the growth analyzer, you're going to get a nice little report card and a little circular chart. So you're going to find out that it has the highest growth potential and a very strong growth rate, which is equivalent to an A. So,
and we actually, a member had a question. How do they get to the growth analyzer page? So if you go to the growth investing website and you look at slide 24 that Cindy had, there's that little analyze button right there. So you would just simply enter a ticker symbol, and you could enter it there, and you get to the analyzer. You could also go to the tools drop-down menu. But those are the 2 spots as subscribers. You can go ahead and analyze any company you want to, even those that are not in our portfolio or pass any kind of filters. As long as it's publicly traded, you'll get an analysis there. So thank you for that question.
That's great. Thank you. And also in the growth analyzer, you're going to see some chart information with statistics about trading information, and then you're going to get information on the actual criteria, the ROA, the cash flow. And you over here in the report card, you're going to see that the accounting conservatism includes R&D intensive, CapEx intensity, and advertising intensity. For BJ's, obviously, it's a wholesale club. They probably don't have a lot of R&D. If they're doing R&D, it would be really fascinating to understand what they're doing.
Yeah, and the fun thing about those intensity things is that really kind of helps explain. These are if it is relevant, obviously R&D probably not for BJ's Health Club, but these are things. If companies are spending a larger proportion of their overall financials on things like R&D or CapEx, advertising, that's money they're spending now, which may be hurting their current profitability, but should pay benefits down the line. So that's what the G-score helps to look at, those kinds of factors that are company activity today that should help support growth down the line. That's why, in that case, those are factors that are considerations within the G-score.
And the final thing I wanted to point out with the growth analyzer, instead of accessing the chart, you can look at the growth grade history for a particular stock you're analyzing. So you can see for BJ's Wholesale Club, it is kind of held steady at 91 for a long time. So this will give you an idea of how the G-score and the growth grade and how everything has formulated and provide some level of information about the consistency. Okay. So what is up for 2026? Unless, John, if you had anything else you wanted to add about the website.
No, I think again, there's a lot of tools there. We try to focus in on perhaps good or bad, the factors that are used to manage the portfolio, whether or not we do it ourselves or you as a subscriber can manage your own portfolio. So some of the things, I know that you've got a slide later on, I think it talks about valuations, and some of our members have asked about, well, you know, they're more of a GARP approach or value approach when it comes to picking stocks. So you could use other tools, but maybe we'll talk, maybe that may be something to talk to our developers, maybe we want to add some additional elements to our analysis. But yeah, the focus is giving you all the analytics you need. We want to make this as transparent a system as possible. We're not trying to make this black boxy. We're trying to give you all the factors that are used to create these growth score, create the G score, that you could understand why stocks are attractive or not based upon the rules of the portfolio. So we're trying to give you all those tools that, you know, that are based upon sound principles and are based upon research. So that's a great overview. Thank you, Cynthia.
Okay. Moving into the first quarter of 2026, we are obviously looking to understand what the earnings growth rates are going to be. And as of January 2nd, last Friday, the LSEG Data and Analytics team estimated that the growth rate for the first quarter will be 14.4. So this does not include the energy sector. So if you take out the energy sector, it improves slightly to 15%. And S&P 500 expects to see the share-weighted earnings of 609.2 billion during the first quarter, and that is up from 532.7 based on a year ago earnings of 503 constituents in 2025. So thinking back about how does this compare to the fourth quarter of 2025 of 8.9, and if the energy sector was excluded at that time, it would have been 9.2. So, and then looking at the whole year, 14.6. So those are just maybe two data points to keep in mind. This will move around and it will be updated as we move through the year. And then another thing to keep in mind, we're coming off of 3 years of spectacular growth and returns in the S&P 500, 17.9 for the year that we've just completed, 2023, 26.3, and then last year, 25%. Those are pretty spectacular. So what this slide is illustrating is kind of the rarity of back-to-back gains of 20% in the S&P 500, and what, you know, it could happen, but it isn't that common. So in the late 1920s, we had strong gains in 27, 28, and then if you see up here, kind of a bad year in 29 with a 8.4% loss. So I think what we need to keep in mind is that, you know, temper our expectations and think about diversification, and just, you know, we're kind of at a high level. It will be harder to impress and maybe do better.
And you know, I know we never talked about this, Cindy, but it is the second year of the presidential cycle, which is typically the weakest year of the 4-year cycle following, if you believe in that stuff. Technically, the last year should have been bad too, but I guess, you know, there's always an outlier, right?
That's a good thing to keep in mind. Usually the first year is pretty strong, so yeah. And then looking at several different PE ratios, we know things are a little expensive, and the S&P 500's PE ratio now is like 22x, so it's above its 30-year average of 17.1, and it puts it in a little overvalued range. And the same with the Shiller CAPE ratio with 39.8 and comparing it to 28.5. But if you think about the dividend yield, that's just 1.34, which is lower than that historical of 2.0. So that means, you know, higher valuations relative to income generation. And thinking about our friends at the Federal Reserve, this is reflective of, you know, target rate probabilities for ending the year. If you can think ahead all the way to December and December 9th in particular, when they have their meeting, there is about a 76% chance of a couple of rate cuts. So we'll see what happens later in the month. And that there is some political or I guess policy uncertainty or unease with the Fed, with Powell leaving in May. And then there's been talk in a lot of the financial publications, which I know all of you are readers of, or many of you, about how the Fed is losing its independence, or there's a concern that it may not have as much independence in the future. So just a couple of things kind of recapping about stock valuations. They're high, and the growth investing approach is not a growth at a reasonable price approach. We're looking for those strong, sustainable revenue growth and positive cash flows. So a lot of our candidates have high multiples with price to earnings, book value, shares, and cash flow. And just to illustrate that, here are the holdings. And I ran these through the VMQ analyzer using the VMQ view in the My Portfolio tool, AAII's My Portfolio tool. And these have, absolutely bad value scores and grades. So 11 of them have F. The rest have D's, and there are a couple with C and only one with B. So just wanted to show you how that looks, and that the big takeaway is that higher valuations often accompany that strong growth expectation. And this slide, you may be saying, okay, this is from 1990 to 2009. And what this slide is illustrating, it is a slide with data from that past time frame. But the big thing that it's illustrating is that the longer you hold a stock, the less impact the price to book value has. So that impact drops significantly as your holding period increases.
And the fact that that impacted more over the long period of things like sales growth and profitability, which are sort of the underpinnings of why we're more comfortable adding in higher valuation holdings to the growth investing portfolio, because the holdings that we're adding should have that consistent growth and profitability as far as their overall process. So the longer you hold a stock, and this is almost looking back at Warren Buffett type stuff, you want to make sure you're buying good quality companies that have high moats and profitability and the ability to raise prices. So that's those are all things that kind of point to a company that has sustainable advantage of some sort.
Well, that's great. Thanks, John. And for market risks in this year, I mentioned the policy uncertainty with the Fed. And we also have continued tariff negotiations and kind of unpredictable or uncertain trade actions. So those can weigh on businesses as they're planning for investment. And we talked about the market valuation being high. So the less upside, markets may be less forgiving when there's a hiccup. Other market risk factors that I see, consumer resiliency. So rising household debt, that could negatively affect consumer spending, and anything that could boost inflation would also cause consumers to be a little less resilient, which ties back into that consumer discretionary sector, which we do have a significant number of stocks in. And the labor market weakness. So if we continue to have stagnant wage growth and we have an increase in unemployment, that could create some headwinds. I think we're really in a transitional phase where some of the kind of well-paid entry-level jobs that a lot of new graduates are seeking are just not available because they are being replaced by AI, or AI is kind of shaping them to be different opportunities. And geopolitics, any global conflicts, that also impacts the economy and the market. So trends and opportunities. Technology and AI continue to be a trend and opportunity, but as John pointed out, AI is good and bad. We talked about HubSpot and how HubSpot was, kind of clobbered by AI. DocuSign is, in the same boat. Some of the chat software incorporates a similar feature, but companies are starting to really adopt AI. JP Morgan in some of their recent commentary noted that 55% of large firms, they're piloting what is called an AI agent. And what an AI agent does is it is designed to do a specific task or to go through and execute a specific workflow. So in addition to the piloting, there are a number of companies that have already deployed this technology and are actively using it. FinTech continues to be an opportunity, and the healthcare and biotech, we talked about Eli Lilly and, the weight loss drugs and some of their innovation. So these are our opportunities, and thinking about what is in store for growth investing. So we're going to continue to seek out those long-term secular growth opportunities, businesses that are sustainable, and in the short term, the Fed reserve policy, inflation, those are things that can cause volatility, introduce volatility, and sector leadership, that will change. And we know that the sector leadership can affect the performance of the portfolio, even though, our growth story is solid and stays constant, and the individual stocks are ones that have that long-term potential. So with the rules-based approach to buying and selling, we're going to be examining holdings that are meeting that 3-year rule to see what to do with them if they no longer qualify, and reconsider making an investment in something from the ideas list. Okay, so that concludes what I had planned for today. John, if you have anything to add. Please.
I guess we probably have a lot of questions for people to answer, so I'm going to let thanks for providing a great overview of the portfolio. I think we have a lot of good questions coming up, and Jenna, why don't you go ahead and I know there's some little marketing push here. Why don't you go ahead and give us a little promotion here, and we'll get into answering your questions.
Yes, as we mentioned, we're the third day into the Model Portfolio Review Week. We do this annually, and we look forward to doing this every year. So one of the things that we like to offer our members, because not only do we have members who are growth investing subscribers and also platinum subscribers, but we have a lot of AI members who may not be subscribed to a premium product or growth investing to be specific. So we wanted to offer a special discount for those who are interested in subscribing to AI growth investing. If you visit AAII.com/webinar-week, I'll put it in the chat one more time before the webinar ends, and then we have it up on the screen as well. I think it is also in the PDF. You can enter, you can choose between a lot of different premium products, even including AI Platinum, which is our bundled service. And if you enter the promo code WebinarWeek50 at checkout, you'll be able to get $50 off a new one-year subscription to any of our premium products. And this deal expires January, I believe, 10th at midnight Central Time. So if you are interested, please take advantage of this. If you have any issues subscribing or have any just questions, you can feel free to email us at members@aaii.com, or you can give us a call at 312-676-4307, and that's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. And I don't want to take up too much of your time because I know we have a lot of great Q&A, so I'll turn it over back to John. Thank you.
Well, thank you. And please, Jenna, also keep an eye out for questions for us. So please feel free to feed us questions. You probably have a quicker ability to find them than I can. But Cindy, if someone was getting started, I see one question here. Someone was getting started with the portfolio. How would they, what would be the best way to go about it? Do you buy all the stocks? Do you look at those that have that are currently qualifying? And do we have any resources for subscribers on our website to get that information?
I think you could do this several ways. First of all, you could, if you're looking for information on the website, I'm going to flip back, just bear with me. That would be in the how-to. So our how-to does have a lot of great information, but back to the question, what you could do is you could, if you're nervous about buying stocks in the portfolio that do not qualify, you could go to the ideas list and select stocks with similar characteristics or similar grade and G-score profiles, or in terms of weighting, you could set them up equally, or you could just weight them however your criteria or your budget or allotment allows you to.
Makes sense. And I guess a member here had a question as to why aren't all the stocks that are in the ideas list not added to the portfolio automatically? Like, why do we only pick some of them at a time as opposed to having just all en masse buying them all?
Oh, in terms of if something's on the ideas list, yeah, and it qualifies, and we've made a decision to sell.
Well, no, I guess just why not just simply buy all of them? Like there are. You said how many companies currently passed today? Was it 40 or something?
Yeah, sure, you could do that. Yeah.
Because we don't do that because it becomes impractical for most people to keep track of that many stocks at once, and it'd be probably a little bit more transition than we want to. So obviously, our performance could be different than what yours would be if we did that. But it's like anything. Often the rules for buying a stock are slightly different from the rules from selling it. If you're a value investor, you may want to buy it when it's super cheap, but you may want that valuation to go up a little bit before you sell it. So that's one of the reasons. But no matter what, the ideas list is always our starting point for adding additions, and it's also what we compare against what we're considering, getting rid of from the portfolio as well.
And I think the number of 20 is a good number.
Yeah, most individuals would have a tough time, I think, keeping track of much more beyond that. If they're really going to be doing in-depth analysis.
you might have performance that differs a little bit, or your portfolio would have overall different characteristics if you bought one of everything.
In terms of rebalancing, I mean, like, you know, do we do any rebalancing in these portfolios? And if so, how would a subscriber follow that as well?
A subscriber would follow that. Probably the best way is through the commentary. So if we violate a rule where we have a stock that becomes the percentage is larger than the average and larger than our allowable amount, we might look to rebalance, but I would cover that in the commentary.
And I'm seeing, you know, a lot of questions here with members that are struggling with the notion of buying a stock that it really has a poor valuation score. I mean, what would you say to the individual? I mean, should they, if they really believe in value, I guess you could go ahead and use the A+ investor portfolio tools that you use to look at the valuation and just kind of cherry pick those. But how would you address that question? Seems like it's come up a lot with the people that are perhaps, are bargain hunters as opposed to people that are looking to buy the next big growth companies.
I would say that with the growth portfolio, you're looking for something a little different. You're looking for that long-term growth potential. I do think it is hard, maybe use a limit order to try to get something when it's a little lower. But yeah, that's a really challenging question, John. I don't know if you have any.
No, I guess it's
just based on that. Yeah.
Well, the challenge is I think you have to really, maybe you build a paper portfolio for a while, because I think ultimately, any strategy is going to take a number of years to really play out and capture the effect of what you're looking for. And if you don't believe in the approach, you're going to basically jettison the portfolio probably at the wrong time and for the wrong reason. So if you don't really, you have to become comfortable with the approach and have it really match your DNA. Again, if you're not comfortable buying higher valuation stocks, then consider the VMQ approach, and that perhaps more into your DNA, and you could live with that over the market cycles. So I think one can't tell you which is the right one for you. You have to decide that, because if you don't, and I think. Ralph Wanger, I think in some ways, I remember him spoke to one of our national meetings, and he said basically, investing is like a religion, in the sense that you don't change your religion week to week. You have certain beliefs that you follow, and that those form the basis of how you interact and work and whatnot. So in this case, I mean, I don't want to downplay religion, but investing, in that context is you have to follow something you really believe in and stick with it over time and grow to appreciate its nuances to make good decisions.
I think that paper portfolio is a good idea. I worked with a new subscriber early last year, and she said, well, I don't know if I'm ready to actually buy anything yet. How can I kind of practice investing? And so you would use our new investing hub or my portfolio, and just you could set something up and keep an eye on it.
And I have a member here who's asking, a company they've seen the stock price go up a lot, but it has a low G score, and they're wondering why that discrepancy exists. And I think the important thing to consider is that both the growth grade and the G score are really agnostic to price. They're looking at company fundamentals. In the case of the G score, looking to see what kind of activity the company is doing. Is the company investing in its future? Is the company profitable over time? Does it have a high return on its assets? So those are the things that I think that are earnings consistent over time. I'm sorry, sales consistent over time. That is true of the growth score as well. Do we have consistency of sales and profitability and whatnot? So those are all agnostic to the stock price. So a company can either have a high stock price performance or low stock price performance and have a high growth grade and a high G score. Those are based upon company fundamentals. So there is no connection directly. But as an individual investor, we do have 5 different factors that are predictive of stock market performance. You can add in momentum to your discussion decisions. You could add in earnings estimate revisions. You could add in valuation as well. We have quality in here already. Those are factors you could add in if you wanted to match it up with what you think are more important as far as buying in at any point in time. Jenna, any other good questions you see out there?
I think the only other one that hasn't been touched on really is, we have obviously our growth portfolio presentation today. We have our value tomorrow. As an early retired person, should you be looking at growth versus value? What kind of considerations as far as risk should be considered?
Well, Cindy, you have a pulse on both of those approaches.
You do, that's true.
I'm going to say that diversification is good, and holding a percentage of both is probably a very healthy thing to do.
Yeah, I've done that over the years. I actually will have I start off having my portfolio kind of equally balanced between growth and value components, whether it's done through individual stock holdings or funds or ETFs. And then basically I put more money in to the segment that's underperforming. Or if I need to withdraw money, I'll withdraw money out of the segment that's outperforming, kind of as a natural form of rebalancing, and in effect contrarian in nature, in the sense that I'm putting more money into the sector or segment that's underperforming.
That's another way to look at it, is what is doing well, and kind of that whole sector rotation and how that plays into the portfolio.
Of course, as we've seen, sometimes things can run for years, right? I mean, no one rings the bell. I mean, we've been talking about high market valuations for some time, and if you are a subscriber to the sentiment investing service, you could see how we have different measures of market performance. We have valuation, which has been showing red for some time, but then we have things like market breadth and momentum, which is on the upswing. So investor allocation, people are largely allocated in stocks now versus bonds or cash, and I mean the market keeps going forward. I wish we had a crystal ball. Maybe we'll bring Charles with his nice crystal ball and tell us what the market will be doing. But I know long term the market's up, and if you have a long term perspective, if you want to be in the market for 5+ years, then stocks should be a reasonable bet to help achieve that, as opposed to cash. But if you have a short term perspective as far as when you need the cash, I mean, no stock strategy is really going to be a guarantee that you're going to get the money out that you put in a short-term basis.
Yep. Like the bucket strategy for retired.
Very much so, yeah.
It's true. People looking for income.
Well, Jen, you want to wrap things up for us?
Yes. Well, first off, I want to say big thank you to Cynthia for guiding us through the AAII growth investing portfolio. I know I learned a lot. Our members are, definitely, it was great to just go through what, the portfolio challenges and wins from the year before. And I also want to thank, John for fielding all the Q&A. I appreciate that. Is there any, before we move into kind of some really important information that I want to share with the group before we sign off, I want to just give a few moments for Cynthia or John to give any last comments or thoughts to the audience.
Well, I'm gonna step in here, Jenna, because I'm disappointed in you. You tried to initially stump me on Monday, and you tried to stump Charles yesterday on a question. Is there anything that surprised you about the growth investing portfolio? So here I was ready for that question, and you didn't ask me. But I'm going to ask Cindy.
There we go. Pass the buck.
Looking back at the growth investing portfolio over the last year or 3 years, whatever, is there anything that surprised you about the market performance this year, and any takeaways from that we should have as an investor?
I think one surprise just in general was how quickly the market recovered, and that it did recover after the volatility in early April. due to the tariff announcements.
I agree. That was a big change. And I guess for me, adding on to that, I think it was interesting how the market started to rotate a little bit as far as the sector interest as the year went on, whether that was a function of the interest rates continuing their trend down and the perhaps growing comfortable that the tariffs weren't going to necessarily be initially very inflationary, but we saw a lot more investor interest in a broader market than we had previously. We saw interest in healthcare that we really haven't seen in a while, even smaller caps in value. So it was kind of nice to see a broadening of the market participation. So
and the international performance, I thought that was interesting.
Point. Yeah, very few people are ignoring the impact of that. And again, I know that last few years, last decade or so, the U.S. markets have been dominant. But I mean, again, it's a good way to provide some, the best time to do some diversification and is to invest in those segments that have a good long-term track record, but that have been underperforming in the more recent past.
Excellent. Those are great takeaways. I appreciate that. And I wanted to share, if you have any questions, because I know we threw a lot at the audience as far as, the growth investing portfolio, its performance, holdings, the growth grade, the G-score. If you have any questions about any of those items, or even just AAII member benefits as a whole, please feel free to email us at members@AAII.com. And then I just want to reiterate, so it's very clear, the AAII Growth Investing Portfolio is a premium subscription, but it is also a part of our Platinum subscription. So if you are an AAII Platinum member, you get access to the AAII Growth Investing Portfolio. And then, as we mentioned before, I always like to reiterate at the very end, all webinar attendees can get $50 off a 1-year premium product subscription, including AAII Growth Investing or AAII Platinum, when they use the promo code WebinarWeek50 at checkout. Simply visit ai.com/webinar-week. And then remember, the offer is valid. Actually, I misspoke earlier. It is valid through January 12th, midnight Central Time. And then if you'd like to attend any of the other webinars this week, please visit aai.com/webinars to register. The next event will be VMQ Stocks tomorrow, January 8th at 1 p.m. Central Time, and Cynthia will be joining us again. And then on Friday, we also have our Stock Superstars report. We'll see John then at 1 p.m. Central that day as well. And then lastly, this presentation was recorded and a replay will be available at aai.com/webinars early next week. And then webinar attendees will receive an email with a link. You'll also receive a copy of our presenter slides, as well as any other links to resources we discussed today in that email. And remember, we have events all week long. So we have, like I said, we have VMQ tomorrow and then SSR on Friday, and they are all free to attend. So please join us at one or more scheduled this week. And then all events, again, begin at 1 p.m. Central Time, and then just go for just a little over an hour, depending on the length of the presentation and how many Q&As we have. And we hope you join us for another event. And with that, we wish all of you viewing good health, good fortune, and a great rest of your day. So thank you so much, and take care.
Thank you so much for attending.
Thank you.